Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
A long and distinguished list.
Oh, there we go. The things that we have to say each and every single time.
We sit atop.
Yes. Yes, we do.
Okay, that's it.
But hey, at least there's not some 2 minutes of ads that we have to run through before we get to talk about what we came here to talk about. So.
That is true.
Think it through. Think it through. Today,
AG1, if you need a new podcast.
Oh, light.
Saw stop. I mean, whoever.
Yeah. Yep.
We are for sale.
Yeah. Sure. So, life insurance, eh?
Yep.
Indexed life insurance or indexed insurance contracts. That's what we came here to talk about.
Yeah. We're going to talk about how those evil life insurance companies take all your money.
Take it all.
Instead of paying it to you.
With fanciful promises of making you wealthy beyond your wildest dreams if you just buy an indexed universal life policy or an indexed annuity.
Yeah.
I don't actually think that's going on, but that's one of the opposition party's claims. So we want to address the subject of indexing.
Yes.
And the persistent question regarding why indexed products see fluctuations in things like their cap rates and participation rates.
Yep.
And what specifically is going on. And the one really critical aspect that we want to address today is the insinuation that insurance companies will reduce or keep lower cap rates and participation rates in their efforts to make more money.
Yeah.
So we're going to get into all of that, answer that question. But there is a lot to consider here. So I want to take a step back and address like how exactly indexing comes together.
Mm-hmm. Mm-hmm.
So if you buy an indexed annuity or an indexed universal life insurance policy, or I suppose even now there are some whole life policies with indexing features for the dividend, how the insurance company is allocating those funds to actually do the indexing.
Yes.
Now, we'll also start by noting that indexing is not a way to just blow the doors off your savings activity. It's really just a way of enhancing some of the interest that you would earn on a fixed interest contract.
Right. Which is why it still sits squarely in the fixed world and not the variable world.
Correct. So when an insurance contract exists that has an indexing feature, the insurance company is going to cut up the money into basically three buckets.
Mm-hmm.
One covers the guaranteed contractual features. So whatever that insurance contract, be it life insurance or an annuity, guarantees to you, the policyholder, there needs to exist money to cover that feature.
Right.
And the insurance company needs to allocate the funds towards investments that will make that guarantee a reality.
Yep.
So money's going there.
And that's kind of an interesting overlap between all life insurance contracts, right?
Mm-hmm.
If there's a guarantee, the money's being invested, I'm going to say basically the same. I have to put a qualifier on it because I can't swear it, but it's being basically invested the same way they would invest for the guarantees in a whole life contract or a term insurance policy.
Yeah. Yep. They need to come up with the funds that will give them the ability to do what they've promised to do.
Right.
And for indexed contracts, this is also fairly true for other non-indexed contracts, the majority of the money is going to go to this bucket.
Right.
It has to. That one's critically important.
Yep.
The next piece is a deduction, if you will, from the pie for the sake of profitability.
And the pie is your premium, by the way. We don't have to be cryptic, right?
Yeah, your premium and or the cash that exists.
Yeah.
amongst all of the policyholders.
Right.
So there is a deduction taken. Functionally, the way this would work is it's a deduction taken from the income that is being generated by those assets.
Right.
But there is a deduction taken simply to cover the insurance company's expense of being in business.
Right.
So it has to operate. It has to pay its employees. It has to print the statements that are going to get mailed to the policyholders. It has to pay the property taxes or the rent on the building it assumes. I realize this is incredibly basic, but these are things that insurance companies have to raise money for. So there is a deduction from this pile of money that goes to the insurance company purely for its need to make some money here.
Right.
And then we have what we would call the hedging budget if we want to get a little technical with insurance speak, or we could just think of it as the options budget.
Right.
This is the money that will go towards purchasing the financial instruments that are necessary to create the indexing feature.
Yes.
Which are primarily options, derivatives, puts, calls, things of that nature. So those are the three allocations that will take place for an insurance contract that has an indexing feature. And something else to realize that may not be super intuitive to the layperson. If we increase the allocation of these various items, so for example, more money goes to the guaranteed bucket, that is going to reduce the amount of money that is available for the other two.
Yep.
So a contract that has really, really, really high and rich guarantees is going to take money away from those other two features. And we're most notably going to find it as we zoom out, reducing the budget for options, which will most likely create lower cap rates or lower participation rates.
Yep.
Now, there is one area of speculation that goes on, especially among those with a somewhat negative view on insurance in general, but specifically index insurance contracts, that goes a little something like, well, actually, what they're doing is they're paying you less than they make. And if you just cut out the middleman, you could be making all of that.
Yeah. I would say that's the most pervasive insinuation, is that people will look at, let's just take the most basic, let's just assume we're looking at an IUL contract. The most basic indexing account in there is the S&P 500 annual point-to-point, that starts on one date, ends a year later. And people go, well, the S&P did 26% during that time frame, and my contract paid me 10% because there was a 10% cap on that index account. So that means the insurance company kept 16%?
No.
That's not how that works at all.
No. Nope. It's not. And the other piece that's important to understand about insurance companies, their investments, and the regulations that govern what they're allowed to do and not to do. Insurance companies are not allowed to speculate with options.
Right.
So they cannot buy, for example, calls on the S&P 500 and be in the mindset of, we think this is going to be a roaring year. We think that by the end of the year, the S&P 500 will be up 25%.
Yep.
But we're going to set the cap at 10, and we're going to keep what difference we make from owning those calls.
Right.
And it's going to be fantastic for us.
Right.
They cannot do that.
That's not how that works.
With some extremely limited exceptions for the explicit strategy of creating income, there is a little bit of allowance to use things like covered calls or even cash secured puts inside the insurance general account. But that's it. They cannot do roaring kitty type stuff. That's not allowed. So when an insurance company uses options, they are using them to hedge. That's why we often call them hedging budgets.
Right.
So what the insurance company is doing is figuring out the basket of derivatives it needs to own if it's going to make a 1-year bet on the S&P 500 being up a certain amount.
Right.
And that will allow them to set the floor and the cap, or in some more advanced situations, the floor and the participation rate, no cap.
Right.
That will become the interest payment to the policyholder.
Mm-hmm.
But there is little to no profit taking that is going to exist in that world. Now, I'm not going to tell you it never, ever happens. There are going to be times that they happen to be in a position where they own some derivatives and the movement of the market put them in a place where they end up making a little bit more than the applicable cap rate, for example.
Right.
But it's not all the time. And it's not the objective either. Because when you push the investment basket to a degree that would produce a gain, if, for example, you have a cap rate, but throughout the year, you can end up with an effective, let's say 12% gain versus 10% on the cap rate. That means the insurer was taking on some risk possible for the downside that was unnecessary.
Right.
And one thing insurance companies absolutely hate doing is taking on more risk than they need to.
Right.
And one thing regulators that watch over what insurance companies absolutely hate seeing are insurance companies who take on more risk than they need to.
Right. Yep. That is absolutely true. And I think now's a good time to, let's go back to, remember those 3 categories that you named.
Mm-hmm.
So money goes to guarantees, profits, and the options or hedging budget, as you called it. In a basic world of cap rates, that's why you see the changes, because when interest rates go down, this is where people get confused because they're like, well, it's an index account. What do interest rates have to do with it? Well, remember the first part is guarantees.
Mm-hmm.
The investments that insurance companies make to honor guarantees are interest sensitive investments.
Yes.
They just are. And so when interest rates go down, that means they have to allocate more money, more of the pie to meet the guarantees, and they have less money for the options budget.
Yep.
And that's what controls participation rates and cap rates.
Yes. The other piece outside
there's a lot of smaller components, obviously, but
the other piece outside of interest rates is volatility.
Yep.
So volatility makes option pricing more expensive.
Yep.
So the insurer may be in a situation where it's not changing the income it can earn from the fixed interest side of the puzzle, which is basically bonds, but it can't buy those options at the price it could a year ago.
Right. So they have to bring the cap rates down.
Right.
Yep.
Now, those are the things that put downward pressure, or in some cases upward pressure on caps and participation rates, because it is true, and we have seen it, when conditions turn in the opposite direction, interest rates go up or volatility goes down, we do see cap rates increasing. We do see participation rates increasing for those that are uncapped or use a participation rate.
We saw it for the last several years.
Yep, we have. We certainly have. There's even a lot of in-force business that is 5 to 10 years old that has seen cap rates go down and now come back up.
Right.
Can't speak universally for everybody, but there has definitely been a trend among the majority of insurers to bring cap rates back up as conditions have allowed that to happen.
And I would say that in our experience, some of the contracts, the older contracts that have not brought their cap rates up as high as you would like for them to be is likely because, this is anecdotal, but I think we both noticed this. Those contracts have much richer guarantees than contracts that are issued today.
Correct.
And those guarantees are more expensive for the insurance company. So they just can't. They have to stay within the guardrails.
Yes. Yes. There is, just to do a little bit of inside baseball, one other aspect that drives some of the expense aspect here that is very, very, very unintuitive, because unless you kind of are inside and you would not necessarily pick this up. But most life insurers do not themselves put together the investment strategy of options that creates the index.
Right.
Most insurers hire a third party to do that.
Right.
Because they rely on the investment scale and prowess of third parties that are actively engaged in options trading all day, every day, versus the people who are managing the general account, who are generally focused on a different style of investment. So when you hire a third party to do these things, you are, and I'm going to make this sound wildly more significant than it really is, but you are at the mercy of the ability to put the basket together and the price taking that third party is going to command when it does it for you.
Right.
So there are a limited number of insurers who do it themselves. Yep. Very limited number. And in general, they have higher cap rates or better participation rates. But the others who rely on third parties, which is a big piece of the overall marketplace, do generally have lower cap rates, relatively speaking. And that also will play a role in their ability to move cap rates or participation rates around as they go back to those third parties to find out what pricing they're going to pay in the following year or so to create the new basket of options to create the index.
Right.
Now, there still exists this criticism that says insurance companies will reduce the caps or keep them down in the favor of profitability. And now we've already discussed the fact that they're not doing it in the sake of they can really get 15% when they're paying you 10. That's not the way that works. But one teeny tiny shred of truth here is the fact that an insurance company could choose to sacrifice the options budget in favor of the profit budget.
Yeah.
Like if interest rates are going down or volatility is going up, we're not going to rob from the guarantee budget. That's a no-no. But we could conceivably decide that we're going to allocate less to that money that's just ours and put it in the options budget to maintain higher cap rates or try to increase cap rates.
Right.
So, tiny shred of truth. But here's the problem practically with that. The amount of money that could be freed up if you brought the profit side all the way to zero is not going to increase or maintain caps to the degree that we're thinking.
Right.
It's not that big a piece of the overall pie.
Right.
So it's not as though the insurer is looking at this saying, well, we could go from 10% cap to 15% cap if we just decided to take half of the profits that we're taking from these policies.
Right.
That's totally unrealistic parameters.
Might be like 0.05.
Precisely. We might be able to go from 10 to 10.5.
Right.
But it's not going to dramatically increase the cap rate. And it also means that we won't have money to hire the people who are going to oversee these things or do the other things that are necessary for running the business.
Right.
And you very much want the insurance company to have those people. You do.
Yes, you do.
That
I've always told people, you want your insurance company to make money.
Yeah.
Otherwise, they won't be around.
Mm-hmm. This is very true. And if you don't think that's true, there's a little company in Ohio that might be able to sway your opinion on that.
That doesn't exist anymore.
So, given all of this, I think people who look at these parameters start to realize that no, it's not something that they're just trying to extract my money from me with.
Right.
But it always calls into question, why then are there these other people saying it's bad, they're just trying to make money off you?
Right.
Because realistically, it's easy to temporarily get into the mindset that, oh, there could be these evil people out there just trying to sell me this crap insurance contract to extract my money from me.
Mm-hmm.
But the truth of the matter is, insurance companies are not sitting around smoking cigars in some back room, drinking scotch, and saying, we know our products are crap. We just need to figure out a better way to polish this turd.
Yeah. Think about it. If that were true, it would require collusion and conspiracy on a grand scale.
Right. It would.
Because they would all have to do that.
Mm-hmm.
Otherwise, they would go out of business one by one.
Yep.
It's a competitive industry.
It is. And it competes not just within itself, but against all the other things that are trying
people
to get
can do with money. Right.
Which kind of illuminates the reason why the negativity exists.
Right.
Because there are competing interests.
Yeah.
And those competing interests want your money just as much.
Right.
It's sort of like politics. Nobody who's challenging an incumbent wins by saying, everything's going great. I just want to be in charge. So vote for me instead.
I got a couple little tweaks I think we could make.
That's not how they win. They win by saying
attack everything.
Right. They win by saying they're eating the dogs and they're eating the cats, and they hope that sways some people.
Yeah, exactly.
But there is absolutely a competitive nature here. This is why indexing exists.
Yeah.
Because insurance companies didn't want to just accept, we invest in bonds and we try to create greater return from scale there, but we've also got to take money for ourselves. So, we're always going to be a fixed interest type asset. So bonds plus a little bit, they were looking for something like bonds plus a little bit more.
Right.
And that's what indexing put on the table. They are trying to build attractive products. They're trying to build products that do deliver a certain amount of benefit to the policyholder, because they understand if they don't innovate in that sense, they're going to die.
Yep. It's absolutely true.
And even the companies that are very, very, very big fans of whole life insurance, who have for years said indexed universal life insurance is bad, whole life insurance is good because it's safer, which is a technically true statement in certain regards, but the practical implication of that is limited. Even those companies have started to introduce indexing features to their whole life products, or started to roll out universal life products that have indexing accounts in them.
Right. Because they have to be competitive.
Mm-hmm. And they want to be competitive. And they start to look at what indexing brings to the table and realize that, okay, this is good for the policyholder, and this will make us a more attractive offering for the general population.
Well, there's a big reason that there's not as many participating whole life policies out there in the marketplace today as there were 30 years ago.
Yeah.
It's hard.
Mm-hmm.
It's a difficult business.
Yep.
It's very difficult. We've heard insurance company executives talk about how difficult it is.
Yep. Now, if you happen to be in the position of holding a very large book of whole life business that's just collecting premium from policyholders, that's a fantastic thing. But that's not something that anyone's going to easily start today and have.
I was going to say, all you had to do, Brandon, was start like 150 years ago, and nobody out there launching a new participating whole life company today.
Yes, correct. Unless you're in the Bahamas and you've got some fascination with Bitcoin, but good luck with that. So,
yeah. Traditionally,
it's
like
hard
traditional.
To do. It's very hard. And
it requires a tremendous amount of capital.
We're not saying that indexing is easy, so that's why they're doing it. But indexing does give them the ability to make something that is competitive with what whole life insurance can create for returns.
Yeah.
In a way that doesn't require the capital necessarily that whole life insurance does. And we have touched on the subject before that guarantees are great, but sometimes they're destructively expensive.
Yeah.
In cases. And that can put the individual who's seeking accumulation of cash value at a distinct disadvantage.
Yes. Mm-hmm. And we've seen companies suffer from that.
Yeah.
Not just individuals.
Yep.
We've seen back in the what do we want to call it? The early to mid 2000s.
Okay.
There was a guarantee arms race, as it were.
Yeah, especially in the variable annuity space. Yes.
Right. Exactly.
Who's got the better roll up?
Which I realize we're not talking about, but it still affects. Those were all life insurance companies. So
there again, not every company did a fantastic job with this, but the roll ups on variable annuities were, for the most part, backed by options.
Yeah.
The whole thing that allowed that income bucket to exist was a hedging strategy that covered the benefit that was being created by the guaranteed minimum withdrawal benefit.
And many of those companies figured out 5 to 8 years later that these guarantees we made are really expensive. And the market conditions that existed when we offered these don't exist anymore.
Yep.
And so, hey, Mr. Policyholder, how would you like it if we just wrote you a check?
Yep.
I mean, that happened.
It did.
With several companies. So it can be detrimental.
It totally can. It absolutely can. Any last thoughts on this?
No, just to reiterate that, no one is screwing you out of money.
No. And there is no secret plan.
No.
Collusion or otherwise. Like, insurance companies do want to compete and they do want to bring competitive products to the market.
Yep.
They just do. Okay. Well, I am Brandon.
And I am Brantley Whitley.
And we will see you next week.